now we'll talk about how you can build a diversified portfolio. The US alone has over 3,000 stocks, and there are many more globally. Fortunately, it is not necessary to pick and buy hundreds of individual stocks in order to create a diversified portfolio. What many people do is instead purchase mutual funds or ETFs, which are short for electronically traded funds. Mutual funds and ETFs are investments that contain groups of stocks and or bonds. In the fund structure format, investors pool their money together and the fund manager then chooses what securities to invest in. This gives individual investors access to a diversified portfolio of securities with relatively small dollar amounts. As the stocks or bonds in the fund generate returns via dividends, interest, and capital appreciation, those returns are then passed on to the investors of the fund. When it comes to investing in funds, there are two main types of investment strategies: passive versus active. Active investing is the conventional form of investment management. The fund manager relies on forecasting and market timing to choose securities that they believe are undervalued. This has been the dominant type of investment strategy up until about 10 to 15 years ago. Fund managers charge higher fees for active management, and investors in actively managed funds do have the opportunity to beat the market. Passive investing is a popular investment strategy that is more cost and tax efficient than active management. Passive investing is often called indexing. Index investment management is a strategy that is based on tracking a commercially developed index, for example, say the S&P 500. What an index fund manager does is buy all the securities to mimic that index. This strategy does not have the opportunity to outperform the index, but it won't underperform as well. Since managers are tasked with just tracking an index, this is the cheapest investment management approach. Mutual funds and ETFs all have costs that are called expense ratios. These are expressed as a percentage, and it is a fee that the fund manager charges to run the fund. Typical expense ratios can range from 0.03% for passively managed funds all the way up to 1.5% or more for actively managed funds. So now we know that we can easily diversify portfolios using funds, and we can choose between active or passive managers. But you may be wondering, what types of accounts can hold investment funds? One of the more popular investing accounts are called tax-deferred accounts, which are individual retirement accounts, also known as IRAs, and 401ks. These accounts give you a tax deduction for contributions, which means that it lowers your current taxable income and saves you on taxes now. And the assets then grow tax deferred. The kicker here is that withdrawals from the accounts are included as taxable income, so they are not as tax efficient during the spend down phase in retirement. Tax-free accounts are Roth IRAs or Roth 401ks. You do not receive a tax deduction on contributions, so there's no immediate tax benefit, but the assets do grow tax-free, and withdrawals are thus tax-free as well, so long as you adhere to certain IRS guidelines. Tax-free accounts are the most tax-efficient accounts during the spend-down phase. Taxable accounts are individual or joint brokerage accounts. You do not receive any tax preference for contributions or withdrawals, and you must pay taxes on capital gains and income generated from the account on an annual basis. These accounts do not have any penalties or special rules regarding contributions or withdrawals like tax-deferred or tax-free accounts do, but they do have limited tax benefits. Even most beginner investors know that to consistently make money in the market, you need to buy low and sell high. This can be very hard to do if you do not have an asset allocation target that you can stick to through every market environment. A strategy called rebalancing is a disciplined way investors can buy low and sell high in their investment portfolio. Rebalancing is the process of selling from the best performing asset classes while buying into asset classes that have not performed as well. By doing this consistently, Investors maintain the target asset allocation of their portfolio, and they can use the market gyrations to their advantage to enhance the portfolio's return while also controlling investment risk. A good example of rebalancing would be to think back to the COVID crisis when it started back in March of 2020. The US stock market dropped nearly 30% in a 3-week time span, whereas bonds held their value relatively well and were even slightly positive during that same time frame. If you had a diversified portfolio of stocks and bonds and adhered to a rebalancing policy, you could have sold bonds at a gain and then reinvested those proceeds in the stocks to take advantage of the lower stock market prices.